welcome to another Gold Nugget. Today's special guest, James Turk from Gold Money. It's a pleasure to welcome James Turk back to the show to discuss the gold market and related economic trends. James Turk is co-author of The Coming Collapse of the Dollar and How to Profit from It, as well as founder of Gold Money. Welcome back, James.
Thank you, Chris.
You know, we're experiencing frigid weather here in the East Coast, but I understand that you're in South Africa where actually it's summertime.
That's right.
James, I'd like to start off with a paper you published in July of last year titled, Can We Trust SLV? SLV, of course, the Silver Bullion ETF hosted by Barclays Bank. You begin the investigation with the SLV 10K, and you note that you're surprised to find SLV shares had the same loose controls as the Street Tracks Gold ETF, ticker symbol GLD. You outline several discrepancies in terminology, which seem to mask the fact that SLV may not be fully backed by silver bullion. Care to tell us more?
Yeah, there's so many loopholes in the prospectus that one really has to question, whether or not the silver is really there. I think, though, for me, the most important thing was reading the actual custodial agreement. It wasn't a bullion allocated account agreement. It was a unallocated account agreement that you would normally find for depository relationships rather than storage relationships. So, one really has to question why you would want to, own SLV. I mean, there are legitimate reasons. If you're looking for exposure to the silver price and you don't want to own physical metal, that's fine. But if you want to own physical metal that doesn't have counterparty risk and so that you can avoid the risk of default or anything of that nature, SLV is not for you. So I guess it's the right tool for the right job is the key. And, if you're a trader, professional speculator, then maybe SLV is okay.
You also discuss an interesting hypothetical situation where the big institutional paper shorts come up with a devious plan here to delay their day of reckoning by manipulating the SLV silver reserves. Care to give folks a brief outline of this scenario?
Yeah, basically there's a huge short position in the market, and I don't think that short position can be met at anything close to present prices. They either have to default on that short position, the shorts that is, or they have to come up with the metal somehow. Now, silver cannot be produced out of thin air like most national currencies can be produced just with a bookkeeping entry. Eventually those shorts have to come up with the metal to deliver or default. The way they would come up with the metal is to have the silver price rise sufficiently high to entice people who now presently hold silver to switch out of their silver and hold some national currency instead. And, given the fact that the precious metals are so cheap, I just don't see how that's going to happen at anything close to present prices. I think we need a much, much higher silver price in the near future. In my forecast for the year, Chris, I was saying that what we should really be focusing on is that old January 1980 high for silver of $50 an ounce. My view is we're going to see it, if not this year, then next year for certain, simply because of the problems with currencies and the actual demand for physical metal.
I really want all of the listeners to have access to a copy. If you would like a link here, please send a request to gsr@hughes.net so you have a chance to read this. This little interview here is not going to do the article justice. And just like the groundbreaking work that James did on backwardization last year, and then we saw gold skyrocket and catapult from those levels as well as silver, I think that everybody's going to want a copy. In another recent article, you discuss a document titled U.S. Foreign Exchange Operations, the Needs and Methods. You believe that this provides empirical evidence in support of GATA's view, the Gold Antitrust Association, that the Fed wants to let the banks extend credit and make greater profits by leveraging undue risks without the consequences on the dollar. Put simply, I guess we'd say the Fed wants to extend as much credit as possible while maintaining the illusion of a robust dollar.
Yeah, isn't that really what they do? A lot of propaganda, a lot of jawboning. How many times has Bernanke said that he's going to take away the punch bowl before, inflation becomes a problem? Here's what they're doing. The core problem is that the U.S. government's federal deficit is completely out of control. It's now, according to my measures, at record levels. I think everybody basically agrees with that. And what the Federal Reserve thinks they can do, and this is probably the thoughts of policymakers in Washington, that by trying to jumpstart the economy, they can get economic activity moving forward that will generate tax revenues for the federal government, and the deficit problem and the level of debt will become less burdensome than it is at the moment. That's what's worked in the past, but we've never had such a highly leveraged economy before. We've never dealt with such huge bubbles before like we're doing now with the real estate collapse in the United States as well as globally. And, one would have to conclude, just looking at the amount of debt, that adding more debt to the present situation is not going to revive the economy and could, in fact, have a perverse effect where not only will it not revive the economy, it will do irreparable damage to the U.S. dollar. And if the dollar is irreparably damaged, then that really is going to undermine and destroy the U.S. economy.